Hello, welcome to part one of the Technical Accounting Update. I'm Janice Parthen, and today I will be providing updates on the regulatory developments as well as standard setting. To give a little background, again, I'm Janice Parthen, VP within RGP's Advisory and Project Services team, leading a number of cross-functional initiatives within finance, accounting, and risk and compliance. My background is in finance and technology process design, risk management, as well as driving continuous improvement for companies. With RGP is a global consulting company serving over 2,400 clients, which includes 3/4 of the Fortune 500. RGP enables rapid business outcomes by bringing together the right people who then together creates transformative change. Now, I'd like to be able to share a disclaimer that the views expressed in this presentation are those of mine and it does not necessarily reflect the view of others. And these slides are for educational purposes only, and it's not intended to be relied upon for accounting, tax, or professional advice. For today's agenda, I'd like to explain and highlight a little bit of the 2021 AICPA CIMA Conference background, provide regulatory and standard setting developments, and provide a quick PCAOB update and inspection results. To provide background, the 2021 AICPA CIMA Conference on current SEC and PCAOB developments is an annual conference which key stakeholders gather together to provide updates on the latest accounting and reporting issues for public registrants and auditors. And this session also highlights the conference topics that were discussed in December 2021, but it's not necessarily all inclusive. So I wanted to at least clarify that. To provide an update on the regulatory developments, Paul Munter, Acting Chief Accountant for the SEC, shared his thoughts on the current SEC developments and along with his colleagues during the conference. He discussed OCA's commitments in terms of high quality financial reporting and emphasized on 3 elements of high quality financial reporting. 1 is high quality accounting standard setting. 2 is the high quality implementation and application of those standards. And 3, the high quality audits. And seek to ensure that investors continue to have the information they need to make well-informed investment decisions. And part of that includes having oversight with FASB and the PCAOB, as well as engagement with the IASB. The other part is having to engage stakeholders through the SEC's accounting consultation process. In terms of the rulemaking activities, there were 3 areas that Paul Munter had highlighted, which included climate risk disclosures, which the SEC had requested for public comment, the trading prohibitions under HFCAA, or the Holding Foreign Companies Accountable Act, and this is applicable where if an issuer uses an accounting firm that the PCAOB is unable to inspect or investigate completely for 3 consecutive years. The third topic is recovery of erroneously awarded compensation, which is a proposed rule to establish listing standards that would require listed companies to adopt and comply with the compensation recovery policy, often known as a clawback policy, should a company's financial information require restatement. This was reopened for public comment. So be on the lookout for future developments in this topic this year. The other item is that I also wanted to point out that the SEC issued amendments to the Regulation SK to modernize, simplify, and enhance certain financial disclosure requirements. The amendment that was last issued in 2020 and is effective for 2021 pertains to MD&A and selected financial data. Another key topic for the SEC included the independent audit oversight. There were a number of auditor independent consultations the SEC received had increased after the adoption of Rule 2-01 of Regulation SK in October 2020. But primary objective is to promote auditor independence and to ensure high-quality financial reporting. Next, I also wanted to provide background and share perspective from the different SEC divisions and offices. There is the Office of the Chief Accountant, and then there's also the Division of Corporate Finance. The Office of Chief Accountant provides consultation on accounting, financial reporting, and auditing concerns or questions, especially those involving unusual, complex, or innovative transactions for which no clear authoritative guidance exists, as well as on issues regarding auditor independence. The key consultation areas that they had noted was revenue recognition, IPOs and SPACs, digital assets, and share-based payments. In terms of the Division of Corporate Finance, this division oversees corporate disclosure compliance with the securities law and SEC regulations. Staff comments in response to filings are often referred in correspondence as comment letters from the DCF. Now, there's also the Division of Enforcement, which conducts investigations into possible violations of the federal security laws and prosecutes the Commission's civil suits in federal courts as well as in its administrative proceedings. These will be a few cases that have been highlighted at the conference as well. Now, transitioning to the standard setting perspective, FASB's top priorities in 2021 were shared by the FASB Chair Richard Jones, and the priorities were providing more disaggregation of financial information, or consider reporting more granular financial information, reevaluating specific areas of GAAP to reduce unnecessary cost and complexity. This includes leases, credit losses, and revenue recognition. Providing more guidance around emerging areas in financial reporting, such as digital assets and ESG, and internally enhancing certain standard-setting processes and procedures to help increase transparency and communication. There is a list of recently completed projects available on the FASB website, so be sure to monitor the effective date and the type of entity applicable, such as a public entity or not. As for agenda for 2022, FASB had issued an invitation to comment starting June 2021. And from the comments received, there was significant interest in digital assets and ESG based on the public comment received to date. As for new projects under exposure draft, there is a proposed ASU focused on liabilities supplier finance program, and the subtopic is on disclosure of supplier finance program obligations. The intent is to have a buyer party of a supplier finance program or programs provide additional disclosure information about the use of the programs and to understand the effect of these programs on the entity's working capital, liquidity, and cash flows. Now, supplier finance programs allow a buyer to offer its suppliers the option for access to payment in advance of the invoice due date, which is paid by a third-party finance provider or intermediary on the basis of the invoices that the buyer has confirmed as valid. I recommend keeping an eye out on FASB's next steps on this. And then in terms of the IASB, Andrews Barkow, IASB Chair, shared his thoughts on the current developments. IASB is currently working on post-implementation reviews of IFRS 9, 10, 11, and 12. And this includes financial instruments, consolidated financial statements, joint arrangements, and disclosure of interest in other entities. IASB also has a work plan for goodwill impairment, which evolved as a follow-up from a PIR in IFRS 3 business combinations. The other big news was that ISSB was formed in late 2021. And in the last segment of the agenda, I will be providing an update on the PCAOB. In terms of the PCAOB updates, the SEC had recently appointed new board members, specifically 4 new members, with Erica Williams appointed as chair. And their priorities are to be confirmed when the appointed PCAOB members begin their terms. In terms of projects and research, there are 3 projects that's been on the priority of the PCAOB. That includes the lead auditor's use of other auditors, and the goal is to strengthen requirements regarding a lead auditor's responsibilities for planning, supervising, and evaluating the work of other auditors. The second is data and technology research. It is how technology-based tools can affect the nature, timing, and the extent of audit procedures performed to address risk of material misstatement. The third is the staff guidance on audit evidence. It's evaluating the relevance and the reliability of audit evidence obtained from the external resources. I also want to just highlight the results from the 2020 PCAOB inspections. The 2020 numbers presented here are the final numbers that were presented at the AICPA and CIMA Conference. But in terms of the observations, it is based on preliminary observations provided by the PCAOB on their website. So in terms of the PCAOB preliminary inspection results, wanted to highlight some common deficiency areas as well as the nature of the deficiencies. In terms of the common deficiency areas, at least from a financial statement perspective, the common themes or areas pertains to the revenue, inventory, and business combinations. And then from an ICFR perspective, it also had included revenue and inventory, but the other alternative is allowance for loan losses. The nature of ICFR deficiencies that were identified related to either a review element, selecting the proper controls to test, as well as identifying and selecting the controls to confirm the accuracy or the completeness of the evidence. And I'll dive a little bit deeper on this to provide some further highlights. So in terms of the highlights of the deficiencies, the key areas that wanted to at least dive a little deeper relates to revenue, accounting estimates, and inventory. So from a revenue perspective, there was a mixture of insufficient evaluation on the applicability of standard and approach in the audit evidence. And some examples that were highlighted include testing of the revenue on the design and the performance of audit procedures, where for revenue based on transfer of services provided to the customer, the auditor did not evaluate where the performance obligations for the services satisfied before the revenue was recognized. Or the auditor did not evaluate whether the customer contracts met the collectibility criteria required to identify a contract with a customer. In determining revenue based on performance obligations satisfied over time, the auditor did not obtain sufficient appropriate audit evidence from the related measure of progress, either input or output method. And in terms of common deficiencies on completeness and accuracy of the evidence, the auditor did not test or did not identify the test any controls over the accuracy and completeness of the data or reports produced by the public company used in the testing. And then secondly, when using data analysis tools, the auditor did not sufficiently validate the accuracy of the information used or validate the accuracy and completeness of the information produced by the public company. And I would say part of this is also in terms of going back to making sure having to confirm the information that you receive in the reports that are generated by the companies that are provided. And when you're having to confirm either from a population confirmation perspective and having to validate those information. Now, accounting estimates. For accounting estimates, allowance for loan losses, the auditor did not evaluate evidence supporting certain assumption changes from the prior year or the lack of changes when evaluating the reasonableness of the assumptions. With business combinations, the auditors did not obtain sufficient appropriate audit evidence to support the assumptions used or perform procedures to resolve any known contrary evidence when evaluating the reasonableness of the financial statements forecast used to determine the fair value of the certain acquired assets. Lastly, for inventory, in some cases, the auditor did not perform procedures to satisfy themselves as to whether the cycle count program produces results substantially the same as those that would be obtained by a count of all inventory items this year. Now, with that, that concludes part 1 of the update of the technical accounting update. Thank you for your time, and I'm Janice Parthen.